The collapse of the Chinese real estate market threatens to bring down their economy and the world along with it. The fate of global economic activity seems to depend on how the Chinese government manages their real estate crisis, which is slightly concerning given that these are the same guys that couldn't even manage to keep the lights on throughout the country due to a coal shortage, even when there were boatloads of coal right off their shores. Today, we're going to look at how a downturn in the Chinese economy could impact the U.S. economy and whether we could be headed back into recession because of it. Let's get into it. Many of our recent videos have been looking at how the collapse of Chinese property developers like China Evergrande could impact the U.S. real estate market. And now we're going to turn our attention to the broader U.S. economy and how an economic downturn in China could hit us in more places than just our real estate market. The Chinese government wants to be the next superpower, and a real estate collapse and economic downturn would not help them achieve this goal. They definitely want to solve this problem, but don't want to look like they're bailing out these property developers. There have been reports that they are trying to unravel Evergrande behind the scenes, and we're seeing signs that Evergrande continues to try to raise capital to make payments on their debt obligations. For the Chinese government to manage this complex financial crisis, they will have to get a lot of things right, which is a bit of a hard sell given that they couldn't even keep the lights on in their country, hitting both residents and businesses. After banning coal imports from Australia over a diplomatic situation, they found themselves in the midst of a coal shortage. Who would have thought that if you ban the import of something you rely on, you'll face a shortage of that something? As blackouts were hitting cities across China, there were literally boatloads of Australian coal off their coast that were not permitted to dock. That's probably not the best way to handle an energy crisis, and I hope they can manage a collapse of their real estate market just a little bit better. And this is no small matter. There are many who see China's current problems as a risk to the global economy. So, if the Chinese economy were to experience a significant downturn, how would it hit us here in the U.S.? Today, we're going to look at how the U.S. economy could take a hit using the components of gross domestic product like consumer spending, investment, international trade, and government spending, and play out how a Chinese downturn could affect each one. First, we'll look at international trade. That's where we can see the direct measurable effects of a downturn in the Chinese economy, specifically looking at U.S. exports to China. A downturn in the Chinese economy is essentially a drop in aggregate demand, and in the case of international trade, that would mean a drop in demand for our exports. Basically, they'll have less money to spend on our stuff. But it will be enough to put us into downturn all by itself. Let's see what the data shows us. According to the U.S. Census Bureau, the U.S. exported about $35 billion worth of goods to China in the third quarter of 2021, which made up roughly 8% of all U.S. goods exports for the quarter. Now, that may be a decent share of our exports, but is it big enough to put us into recession? Let's say there was a severe downturn in China and U.S. exports to them were cut in half. That would reduce our overall real GDP by about 0.2%, holding everything else constant. That would definitely hurt some folks in the manufacturing and exporting business, but from a macro perspective, it wouldn't hurt us that much, and by itself wouldn't cause a recession. Now, one thing to remember is that the world is very interconnected in our present day, and a drop in aggregate demand in China could hurt other countries as well that have large volumes of export trade with them. This could lead to decreases in demand in our biggest export markets like Canada and Mexico. This would compound the effects of a drop in our exports to China, but on its own, a severe drop in our exports isn't going to drive our economy into the ground. Looking at the other components of GDP, it's a bit more speculative as to the effect, but here's how it could play out. A big downturn in the Chinese economy would likely result in a drop in our stock markets, as it could be a prelude to a larger global decline. This could then hit consumer confidence, and people might spend less just because they're more worried about the future. In the third quarter of 2021, consumer spending made up 70% of GDP, which is about average. Any notable drop in consumer spending would hit the U.S. economy hard, and this will be something to keep a very close eye on going forward. U.S. consumer confidence is already at the lowest point in a decade, according to the University of Michigan's Index of Consumer Sentiment. This is due to an escalating inflation rate and the growing belief among consumers that no effective policies have yet been developed to reduce the damage from surging inflation. Given this, a downturn in China, potentially leading to a downturn in the rest of the world, might have an above-average effect on U.S. consumer confidence, given that it is already in a vulnerable state. We also need to consider investment, composed primarily of business spending. This component of GDP would likely take a big hit in a Chinese and subsequent global downturn, as it would create significant uncertainty about future economic conditions, which is an environment that few businesses want to invest into. Over the last 3 recessions, domestic investment dropped by an average of 21% from peak to trough. When it comes to government spending, this is where things get a bit different and potentially more dangerous, given how government policies and their effect on the economy have played out over the last year and a half. If we are to see a notable drop in consumer spending, business spending, and exports, that would be enough to push us into recession if it went on for a period of a few months or more. The U.S. government could push for trillions in more spending in order to counteract the drop in economic activity, much like they've done in 2020 and 2021. However, given the already rising inflation in the U.S. and lingering supply chain problems that are stoking continued price increases, another massive surge in government spending in that environment could push us from escalating high inflation right into hyperinflation. So this is how it could all potentially play out in the U.S. if we were to see a severe downturn in the Chinese economy. It wouldn't happen all at once. There would be lagged effects and feedback effects that we could see along the way, in addition to monitoring the Chinese real estate market and how that is affecting their economy. Make sure you're subscribed here and hit the notification bell down below so you don't miss our updates on this situation in future videos. And if you found this video useful, please give it a thumbs up to support the channel and help us grow so that we can continue to bring content like this to help you keep an eye on the latest trends in the economy. Thanks for stopping by. I'll see you in the next video.